Welcome to the Deep Dive. We grab the latest reports, the newest data, and boil it all down into hopefully the most interesting conversation you'll hear this week. Today, we're putting our investor hats on. We're diving into Texas Roadhouse's Q3 2025 performance, and our mission here is to sort of untangle this paradox, really. You've got a company that's just, a growth machine. Traffic's up, they're grabbing market share, revenue's over $1.4 billion for the quarter. Solid, but profitability is getting absolutely hammered. Costs are way up, especially beef. So how do they keep winning with customers when the financials are under so much pressure?
Yeah, that's exactly the tightrope they're walking. The headline really is two different stories playing out at once. You've got fantastic top-line growth, great traffic, but then severe margin compression. So today we'll break down those Q3 numbers, really dig into that commodity inflation problem, mostly beef, as you said, and how their famous conservative pricing philosophy fits in. And then we'll look ahead. Their expansion plans for 2026 are pretty ambitious, accelerating growth across the main brand, Bubba's 33 and Jaggers.
Okay, let's start with the financials then, because those sales figures are, well, they're really something. Total revenue, $1.436 billion. That's up 12.8% year over year. Huge jump. But what really stood out to me was the comparable sales growth, up 6.1% at their company restaurants.
That 6.1% comp number, yeah, that's the kicker. It really shows how strong their value proposition still is. And the why behind it is crucial. Most of that growth, 4.3% of it, was just more people coming in, actual traffic.
Right, boots on the ground.
Exactly. The average check only went up 1.8%. So they're winning because people are coming back more often, not because they're jacking up prices aggressively. And that translates to really strong weekly sales averages, $157,325 per restaurant.
Okay, but here's where the paradox bites. All that sales momentum, and yet diluted earnings per share actually dipped a tiny bit, down 0.8% to $1.25. And maybe more concerning, income from operations fell 5.0% compared to last year. So what's the one number that really shows this margin squeeze?
It's got to be the restaurant margin percentage. The total margin dollars did creep up a little, about 1.1%. But the percentage view tells the real story. It dropped significantly, 168 basis points lower, landed at 14.3% of sales. That's the core challenge right there.
And just to be clear for everyone listening, 168 basis points, that's like 1.68 percentage points. They lost almost 2 cents of margin for every dollar in sales compared to Q3 last year. That's a big hit. What's driving it?
Yeah, it's a huge shift. And the main driver is pretty clear when you look at costs, commodities. Commodity inflation was running super hot in Q3, 7.9%. And that was almost all driven by higher beef costs, just relentless climbs there. Labor inflation was also up 3.9% for the quarter. Though interestingly, management seems confident they can keep the full-year labor inflation around 4%. They're holding that guidance.
And looking forward, this beef situation doesn't seem to be easing up quickly. Management actually nudged up their full-year 2025 commodity inflation forecast to about 6%. The first leg of 2026, they're guiding to a roughly 7% commodity inflation.
Yeah. And what's really interesting is how they're thinking about it. Management is really framing this as a temporary cyclical thing. They keep calling it the cattle cycle. Tight supply pushes prices up, but eventually it corrects itself. And that core belief is why they're being so patient, so conservative with menu prices.
Okay, but hold on. Industry analysts are forecasting low double-digit beef inflation for 2026, right?
Yeah.
Especially early in the year.
That's the rub. Yes, analysts see higher numbers, particularly in the first half. Management acknowledged that too. They basically said, look, our 7% guide for the year, expect it to be higher than that in the first 6 months, and then hopefully it calms down in the back half.
Which leads us right into pricing. They are famously careful here. Protecting customer value is almost like a religion for them. So they only took a tiny 1.7% price increase at the start of Q4. But wait a minute. If traffic is roaring ahead at 4.3%, doesn't that suggest maybe they're being too cautious? Are they leaving money on the table just to protect this value image while margins get crushed?
Well, that's the million-dollar question, isn't it? And it highlights this internal pressure point, what they call the manager-partner dilemma. See, those managing partners, the ones running the individual restaurants like they own them, their compensation is tied directly to restaurant margin dollars, not percentages.
Ah. Okay, so when inflation eats up the margin percentage like this, those actual dollars they get paid based on, they shrink.
Exactly, even if sales are up. So management is caught between keeping prices low for the customer and protecting the take-home pay of their key operators.
Wow, so this isn't just a corporate P&L issue. It's hitting their people directly. If those margin dollars fall too much, do they risk losing their best managers?
That's the risk, precisely. Now, to be fair, restaurant margin dollars per store week are still way up compared to pre-pandemic, like 35% higher than 2019, so there's some cushion. But Q3 saw those dollars per store week actually decrease 5.3% year over year. That's why they're watching this so closely ahead of the next big pricing review, which isn't until April 2026, Q2. If they have 2 straight years where those manager-linked margin dollars decline, well, that could put real strain on that whole operator model.
Okay, so it's clear traffic is the priority over margin, at least for now.
Yeah.
So how are they pulling in all these people when everyone's feeling pinched? Must be the operations.
A lot of it comes back to winning on that core steak and value combination. They see customers still ordering steaks, bigger entrees, because frankly, people are realizing how good a value it is compared to buying that same cut at the grocery store and cooking it themselves.
Yeah, that's a great point. I saw reports, retail ribeye prices are astronomical, like over $23 a pound sometimes. Texas Roadhouse isn't just competing against other restaurants anymore. They're competing against your own kitchen. That's a really strong position to be in.
It really is. And they're smart about the menu, offering sirloin in all those different sizes, 6, 8, 11, 16 ounces, plus the country dinners. It gives them options across different price points, different income levels. So they're not really seeing customers trade down aggressively or defect to cheaper options. They're holding on to a broad audience.
So the menu keeps people coming, but they're also working hard behind the scenes, right? On the operational side, driving efficiency, improving the experience.
Definitely. Look at to-go. It's still a big piece of the pie, 13.6% of weekly sales. And they say the key there is just relentless focus on speed and order accuracy. They've basically figured out how to handle more orders per hour without messing them up, turning carryout into a reliable profit stream, not just an add-on.
And technology's helping with that, I assume? They mentioned rolling out new systems.
Yeah, about 95% of restaurants now have their new digital kitchen systems and the upgraded guest management tech. Should be fully rolled out by year-end. One thing they highlighted was Roadhouse Pay, letting people pay right at the table. That seems like a small thing, but it smooths out the end of the meal, removes friction.
Makes sense.
But crucially, the goal isn't just speed for speed's sake. They're aiming for efficiency without making people feel rushed. That target table time is still around 54 minutes. Effective, not frantic. That's the balance.
And they're trying other things too, right? To maybe offset some of that beef cost pressure without big menu hikes. Like beverages.
Exactly.
Yeah.
Still pushing those value things like the $5 all-day specials, mocktails, keeps the value message strong. And they're pretty nimble regionally, like testing dirty sodas out in Utah and Idaho where that's a trend. It shows they react to local tastes. And that focus on soft drinks is actually helping. It's driving a positive mix there, which offsets some of the negative mix they've seen in alcohol this year. It gives a little margin lift without touching food prices much.
Smart. And then there's the retail side. Selling the rolls, the spreads. Is that really about profit or something else?
Seems like it's almost purely brand awareness. They said the logo is now in over 120,000 retail locations. So every time you walk down the grocery aisle and see those rolls, it just keeps Texas Roadhouse top of mind for when you are thinking about eating out. Little reminder.
Okay, so operations are hunting, customers seem loyal despite the broader pressures, so the company's solution is more growth. They seem to be really stepping on the gas with expansion, especially buying up franchise stores. What's the thinking there?
Yeah, they are definitely consolidating. It's very strategic. Through Q3, they bought 17 domestic franchise spots for about $94 million, grabbed 3 more just after the quarter ended. And the big one is the deal to buy the last 5 California franchise locations at the start of 2026.
Why buy them back now? Control.
Pretty much. It's about total control over the brand, the experience, the quality, and critically, the pricing. When your whole strategy depends on maintaining that specific value proposition nationwide, having everyone on the exact same page is vital. Fewer variables.
So once that California deal closes, there won't be many franchise locations left at all, only about 31.
That's right. And it definitely signals they're gearing up for a big push in company-owned growth next year.
How big a push are we talking?
They're planning around 35 new company-owned restaurants in 2026. That breaks down to roughly 20 Texas Roadhouse locations. And the CEO kind of hinted that number might end up being higher than 20. Plus about 10 Bubba's 33s and up to 5 Jaggers.
Okay, that's a significant acceleration.
It really is. It means their overall store week growth should pick up speed, hitting maybe 5% to 6% in 2026.
And the Jaggers plan seems quite focused geographically, not spreading thin.
Right. They're concentrating on that heartland region around their Louisville base, Ohio, Indiana, Kentucky, Tennessee, Georgia. Build density, leverage supply chains, learn the model before going national. It's a measured approach for that younger brand.
And funding all this.
Yeah.
What's the capital expenditure outlook?
Initial guidance for 2026 CapEx is around $400 million. That's mostly for building the new stores and keeping the existing ones fresh. And remember that $400 million doesn't include the cost of buying those franchise stores.
Got it. And shareholders still getting returns.
Yep. They bumped the quarterly dividend up again to $0.68 share. And they still have quite a bit left, over $430 million authorized for buying back stock. They did about $100 million in buybacks through Q3.
Okay, so let's try and wrap this up. If we summarize this deep dive, Texas Roadhouse is showing incredible resilience. They're gaining market share, traffic is strong, revenue's high, all proving that core value message still resonates, especially now that they're effectively competing against cooking at home. But, and it's the same big but, profitability is getting seriously squeezed by these runaway beef costs. So the company's response seems to be double down on efficiency tech, to-go operations, and accelerate unit growth to keep the overall engine moving forward.
That captures it perfectly. And the central gamble, the real tension here, is their bet that this intense inflation, particularly beef, is temporary, it's transitory. We've seen them hold the line on pricing very deliberately to protect that customer value perception, which, as you said, drives their success. But you have to ask yourself, what if they're wrong? Or what if transitory means longer than they expect, like well beyond the first half of 2026? If that margin pressure stays intense for that long, how does it impact that crucial management partner compensation model we talked about? Does that internal strain eventually force them to make tougher choices on menu pricing, potentially risking the very value equation that brings people in the door?
That really is the key question hanging over them for 2026 and beyond. A fascinating dynamic to watch. We definitely encourage you to keep exploring how these commodity cycles ripple through the restaurant world.